Hi, this is Peter with Quantum Edge AI, and we're going to construct the diagonal. So what is the diagonal? The diagonal is, in this case for the call side, is the long call further out in duration, the back week, and the short call closer in duration. So we'll construct this in the option chain. And what you want to do is sell the front week, buy the back week, and what we're going to do is sell the closer to the money and buy the further out. So we're going to sell this location, sell that, and then we're going to buy the 235. The reason why this trade is made is because it's a delta neutral strategy and you believe that your risk, potential upside risk, is doubtful. You don't believe it's going to be up here, but you want to still take advantage of this theta decay, and you don't mind if price is over here. You don't mind if it reaches or surpasses the high forecast. The reason why this is advantageous is because what is the likelihood of Apple being up here, really blowing out and exceeding these values? It's pretty low. I would say even in the past 30 days, for it to get to these values, it took quite a bit of time. So even if we did have a movement upward, we do have a bit of time to exit the position in the event we are wrong. So say for example, price does exceed 234. It exceeds this location where the high forecast is. We can get out at a relatively, you know, small loss. But the objective is for price to oscillate in this area in here. And there's two things that are happening. Sure, your risk is the future delta, the change in price. As this happens, you're actually going to be increasing in theta. So you're going to be slightly P&L negative if it reaches this value quickly. You don't want that. You want a slow grind upward where this um, by the time price gets to this location, it's going to be November 15th, and this will be out of the money. And then you'll have this long call, this naked long call, just the solo one contract. So this will evaporate meaningless. You'll net this $54 and you'll be left this one contract. That's the idea. So that's the reason why it's beneficial, because you have that theta decay where this teal line is positive. Throughout this time, you want to be here. If it blows out, then yes, you are taking a loss. But there's really relatively small downside risk. There's 24 cents of downside risk. Um, but there is also technically, $55 of net premium to receive if you believe that price is just going to slowly grind up, but it doesn't have that surprise risk of getting in this area. As long as price is below between 234.27 and 227, where the close forecast is, you're in a good position. As long as price is here, you're doing well. If it rises here super fast, you're not going to net this theta decay. But as long as it oscillates in this channel, you're going to be in a good position. You can also set up the diagonal to be a double diagonal, where you can also create this second diagonal over here, where you're going to be netting this premium faster. We'll discuss that in another video, though. Thank you.